Merry Christmas, you filthy animal.
Well, with that, everyone, welcome to episode 25 of Bullish. Remember, anything that we discuss is not individual stock advice. Past performance is not a guarantee of future results. Stenger Family Office and its clients may hold positions in some of the stocks discussed. For a full disclosure, visit StengerFamilyOffice.com. I'm Sam Hardy. I'll explain what's going on here in just a minute. But joining me, as always, is Nick Stenger and Producer O. We are Stenger Family Office. For the past 43 years, it has been our mission to deliver clarity and confidence to help secure your financial future. If you're not subscribed already, be sure to do that. Like and share the show so we can continue to get the good news, the clarity, and the confidence out there. We got a little holiday special for you today. We're calling it a Bullish Carol, a Stenger Family Office production original. We're going to be visiting the ghosts of Bullish Past, Bullish Present, and Bullish Future. So, Nicholas, how are we doing today?
We're doing good. I'm happy to be sitting here with Ebenezer Scrooge himself, and hopefully today's show can shed some light on why you should be a bull in the stock market and not a doom and gloomer. Oh, show everybody the rest in peace, the tombstone here.
Yes, we got our own tombstone for the Bears. Owen, you can show what's on the screen right now. We're just looking at the year-end projections at the end of last year. So,
and also, it's good for the Chicago Bears. May they rest in peace. Their season.
We don't want to upset any viewers.
Are they going to win another game this year? Do we think it's a pretty rough one? But we fired the coach. Hopefully, on to bigger and better things.
Probably. Time will tell. Producer O is not bullish on the Chicago Bears for the rest of the season. We'll note that in the show notes. So,
and by the way, I'm not bullish on the Bears either. I'm not bullish on the people who are saying that we are going to have a bearish 2025. I think we are going to have a pretty decent 2025. I think a lot of the upward mobility in the stock market might be priced in. So if we see high single digits, that wouldn't surprise me at all. And everyone acting like that's the end of the world, I think is just absolutely out of their minds. 28% for 2024 is a pretty darn good year. I don't think anyone really expected that. We certainly said that things would be okay in 2024. I think we put our estimate out December of 2023 saying 5,200 points would be the number, and that's been the right directional call. And we'll come out with our estimate for 2025 very, very soon as well. But these people who have been bearish, they've completely missed the mark. One person is Michael Burry, who we've been talking about on our show every week as well. And not to, he's a super smart guy. So I just want to put that out there. He did call it in 08 and 09. He's been pretty bearish ever since. He did say in January of 2023 to sell stocks, and the S&P now is up 57%. Since he said that. So just be careful who you're listening to. And I think a lot of these bears going into 2025, yes, we may have a correction, but I think in the long run are going to be wrong as well.
Well, to your point too, Nick, I mean, the average here was 4,861 points on the S&P. So we were even, far past whatever the average expectations were. And yeah, next week, 3 p.m. Central on the 19th is when we'll be doing the Nick Stenger show, live show. Market Outlook. So be sure to tune into that. Have some time for questions as well, if there's anything people have got on their mind. But, it always goes back to the adage, bears are smart. We've never disagreed with that, but bulls make you money, and you just always have to be so careful not to be a pig because it'll get you slaughtered.
That's right.
So,
well, and this is a backward look at what all the price targets were at the end of 2023 for 2024, and who was the best? Was it at Yardeni 5,400?
Yeah, Yardeni at 5,400. Tom Lee with Fundstrat was 5,200. I know Belsky over at BMO, someone we like a lot. He had 5,100. So, there was a lot of those low 5,000s. But yeah, Yardeni.
So Yardeni blew it out of the water.
Yeah, and he's the only one. Remember, when he came to Investor Day this year, everybody was revising up, obviously, after the start to the year. And he hit, I think, 5,800 points on his next price target, his revised one. So even that was, lower than where we're sitting today. So I just thought, let's go back. Let's look through some of the past, what we got right, what we got wrong, and then move on from there. So one of the stocks we talk about often As Walgreens down 63.5% year to date. That's even with a little bit of a kick after some acquisition talks were going on. So, let's see where that goes. If that merger falls or acquisition falls through, it would be really interesting to see what happens.
Yeah, and by the way, just remember this isn't an exhaustive list, so there's other stuff we got wrong too. But I will say I think we got more right this year than we got wrong. Walgreens was a huge one. You put on here they're up to $1.3 billion in cash instead of 730 million. Well, that's not because things are going well. That's because they're actually borrowing. They're just revolving their loans on a corporate level and basically just sending out more debt to the market to try and raise cash. So it's not like it's a bullish sign by any standards. I always thought Amazon might come in to buy this thing. So the only value to me at this point with Walgreens is the value of the leases, which you've seen this happen before. Sprint, some of the other Radio Shack was a great example where they go out of business and then the leases are worth something. They're on these super long-term 10, 15-year leases, triple net lease. And maybe Amazon is interested in those for distribution reasons, but other than that, the stock, in my opinion, is somewhat worthless here.
Yeah, and it's not like 1.3 billion is really enough cash to have on the balance sheet anyway to survive with how many employees they have. So let's hit Nike. That's another one that we thought wasn't a great buy, down almost 27% this year. I know they have some good things going for them. They're a massive, worldwide brand. They just renewed their 10-year deal with the NFL, which obviously will help with some of their reach there, but there is a lot of competition in that space now. I haven't bought Nike shoes in a long time. I'm buying On Clouds or I'm buying Hoka's. It's like, producer Tiny Tim over there ran the marathon this year, so shout out to him. But it's, you watch all these people running by. It's not like it's just Nike and Adidas anymore. There's a lot of other players in that game.
Yeah, Nike's CEO also said, which was interesting, that remote work just doesn't work. You can't have a remote innovative workforce. You can maintain a great business, but it's very hard to grow it and innovate when everybody's in different places and not in the office together at least a few days a week. And so that was a huge point that Nike put out. We did that episode, Nike is the New Disney, just to say, hey, great American brand in distress, but maybe they can turn around eventually. We just thought for the price you're putting on those profits, there just wasn't enough growth there. So far, that was the right call. Down, like you said, 27% for the year. Really tough story. Nike has produced a negative 20% now price return for the past 5 years.
Yeah, and let's hit on Starbucks. This is an interesting one for us. Obviously, it was something we said not to buy. It is up 4.5% year to date, which is obviously way below where the market's sitting at. But the reason for that's that massive pop they got when they basically poached Chipotle CEO Brian Niccol, and the stock ran up like 25% in 2 or 3 days, basically after that news broke.
Yeah, I totally agree. I mean, without that, the stock is complete garbage. It would have been down 22% without that news from Brian Niccol. We'll see. We wish him well. We hope he can turn it around. He did a great job at Chipotle. Obviously, Chipotle has just been an incredible story. How many times a week does somebody from our office go to Chipotle? 2 or 3 times?
Minimum. Yeah,
it's a very rare thing that you go anywhere else that many times. Starbucks is great. I still really enjoy Starbucks personally. I go there. I'll get my, what's our new thing? We get a
macchiato.
Okay, right, a macchiato,
but the little one,
a little macchiato,
2 shots and some little bit of foam.
And that'll amp you up for the rest of the afternoon. But other than that, yeah, I think they've just it's just a valuation story. I think it's a great brand. I think they'll eventually turn it around. But for investors, it's pricey. It could have some room to go down still.
Okay, Arista Networks, that was one from an old Zero to the Moon segment, and that's something where I'll give credit where credit is due for you, buddy. That was your call, up 84.5% this year. Tell us a little bit, again, where you think they're at right now and why you made that call back in the day.
Yeah, by the way, that thing's up 820% the past 5 years. So it's just had an incredible run. Basically, the story there is they've eaten Cisco's lunch. Again, Cisco just has not kept up from an innovation standpoint the way that Arista Networks has. Now, I will say Arista is not a cheap stock anymore. It was trading around 30 times earnings when we said to buy it, and not individual advice. We were just saying it looks good. and it did well. Cisco is trading at 25 times earnings, which I think is actually a little bit pricey for a company like Cisco with very little growth. But the reality is they have a superior product. They've also had a little push with AI. Tom Lee's got Arista Networks as a granny shot stock as well still. So it'll be interesting to watch. But fair warning, it's not a cheap stock anymore.
All right, Tesla. This is one that's hard to keep quick, but we'll do it. Up 80 or 68% year to date. Especially looking at these last couple months, it's up almost 100%. I think we talked about it back in February or March. We said, hey, it could be a good buying opportunity. And then obviously Elon tied himself to Trump, and we've got everything else going on now. But they've also been launching. They had the self-driving event and a number of different things that are worth paying attention to.
Yeah, so Tesla's incredible story this year. We put out a video, like you said, in Bullish, and it was February 14th of 2024, earlier this year. Tesla was trading at $188 a share. It's now trading at $427. You can go look at that video. It's called "Where's Tesla Headed From Here?" We didn't have a crystal ball or anything, but our whole argument was, hey, Elon's turning this thing into reoccurring subscription-based revenue, and that's exactly what he did. Now, the pivot where he supported Trump, I don't know if he really loves Trump seriously or not. I mean, it seems like he does. I don't think he's completely faking it, but there's certainly an incentive there for him to endorse Trump and back Trump, and that obviously has worked out well for him. We'll see what happens with this lawsuit for his compensation package. By the way, he deserves every penny of it. And so anybody who says he doesn't is just, they don't know what they're talking about. The stock's up 1,700% in 5 years. So if you're a shareholder and you don't want Elon to get the pay package that you agreed upon being a shareholder, then don't own the stock. It's as simple as that. Is Tesla perfect? Is it a cheap company to buy right now at the PE it's trading at? No. And Elon's come out and said, hey, our stock is pricey, no question about it. But if you got that little trade in February and you were buying it for 199 or 188, it was a great move. So,
yeah. All right. NVIDIA, impossible to go through this year without talking about it. Up 185% year to date, just continuing its monster run. It's up, similar to Arista, it's up 840% over the last 2 years since the beginning of 23. So I think what things to be paying attention to there really are this Blackwell release, that everything goes smoothly and meets what expectations are. But they've got those GPUs as well as the stack that they're going to start selling, and that's something to really be paying attention to.
Yeah, the NVIDIA story, again, I said this on my show yesterday, it's not all about the AI revolution, which that's a huge part of it, but it's really just computing power. You literally can't run your applications without NVIDIA. And there's companies, and I'm talking oil companies, banks, there's all sorts of companies that have nothing to do with AI or tech, and they can now run reports and projects and big data analysis in a day, what it used on their GPUs, what used to take them a year on a CPU. That's the real story going on. So again, NVIDIA, I don't think is, I go out on a limb here and just say, I still think it's got a lot of room to run. So.
Okay, Casey's up 53% year to date. This is one of those ones where it's like, you're talking AI stocks and that's the only thing that's performing well this year. It's literally like a gas station chain. We got pizza there before we went on our trip, and it was actually decent. So that's just, that was a call. We looked at it and we said
that was better pizza than a lot of pizza places I've been to.
Yeah. I don't want to be too aggressive on it, especially in Chicago here. Everybody's got an opinion on the pizza, but it was much better than I expected. Still got to get into try a breakfast pizza though.
Yeah, Casey's has been a cool story. Stock's done incredible, and again, it's just you're buying a company that hasn't really scaled yet. You're buying a couple thousand stores now, and you could easily triple, quadruple, whatever. If you say, hey, we're really a 7-Eleven competitor instead of just a gas station competitor, that thing easily could be 5, 6, 7x growth. So,
okay. And then last one's ExxonMobil there, obviously the leader in the oil and gas space and energy. I know you've got plenty of thoughts.
Yeah, Exxon's been we put this on here just to say it's been the best energy company. It obviously hasn't outperformed the S&P. It was doing really, really well for a little bit. It's pulled back a little bit recently, and I think part of that is because I personally think we're going into more of a peacetime environment than we've had. There was some talk we'd go into a hot war with Russia under the Biden administration, and now I think if you go back to the Trump era, Trump 1.0, we actually did have peace. And under Trump 1.0, oil did not do well because we had plenty of supply. We were, generating a lot of energy. So
Drill, baby, drill.
drill, baby, drill. So for right or wrong, I just think that the U.S. oil companies are so much better prepared for the next wave of innovation and whatever energy is going to do the next couple years than the other majors around the world. So.
All right. Let's just quickly hit the ones that we got wrong. We don't want to spend too much time on that, obviously. I'm just kidding. Disney honestly had a great year. It's basically in line with the S&P. Really turned it around in the second half of the year here. Disney Plus and some better box office releases have really helped that stock out.
Yeah, it was really a valuation story. Again, a great American brand. We called it American Brands in Distress a few episodes ago.
Yeah.
But you got to realize the 5-year number is still negative 22%. You're buying Disney now for 42 times earnings. I don't know what the right number is to put on those earnings. It's definitely an iconic brand, but it's just tougher and tougher for these content machines to keep being machines that they used to be. You have YouTube now. I don't know about you guys, but I spend most of my time watching podcasts. I'll watch YouTube shows. I'll watch, Netflix or something like that. I don't even think we have a Disney Plus subscription. I know a lot of people do. Maybe eventually, as Jack gets a little bit bigger, we will. But I just think there's so many alternatives out there. It's tough to really understand what the right multiple is. Back in 2015, 16, 17, 18, Disney was trading for anywhere from 18 to 22 times earnings. Today, it trades for 42. So it's just a tough price here to come in and pay.
Okay. Macy's, it is down 17% this year, but that was one we talked about end of 2023, and it's up almost 50% since then. Really, so that was definitely one that we missed. But they had those acquisition talks. It was basically going to be like a takeover that ended up falling through, and they really just were basically convince shareholders, hey, we're gonna fix our brand. Missed that one.
It's a take private, right? Is what they were talking about.
Yeah, basically.
Yeah. And it fell through. It's falling through, right?
June of this year, it fell through. They basically said they're gonna handle it themselves.
And an employee hit $150 million.
Yeah, so there's that as well.
So that's not great.
No.
Okay.
Clearly some issues there.
By the way, how do you miss $150 million?
Yeah, I don't know. There's either extreme negligence or that person's unbelievably smart.
Yeah, and by the way, I don't know if you've been inside of Macy's lately. It's a disaster in there. We walked in, we had to walk out.
Yeah.
It's just not. You can buy better clothes at Costco nowadays.
Yep.
So,
yeah.
Anyways.
No, I get that. All right, last one, InMode, down 17% year to date. Really, from a fundamental standpoint, it's an excellent company, but the stock's just really been struggling to break through and move higher.
Yeah, financing costs have really hurt these small caps, and I think it'll turn around eventually. But yeah, InMode's just really not performed like we thought it might. They've got, I think, $600 million of cash in the balance sheet. The whole company trades for $1 billion. So again, not stock advice. I'm not telling you to do anything with it, buy or sell. But from a fundamental standpoint, a lot of these companies are actually in really good shape, and they just haven't seen the bids in the market. So.
Okay, let's move on to some present things. I want to talk China real quick. Obviously, you had your show earlier this year, Dead Cat Bounce, after they had done their first rounds of stimulus, and the stock just skyrocketed. If we were looking at like MCHI, for example, the China ETF, then it did, in fact, fall way back down. It was a dead cat bounce. It's not even close to the highs now, but they're launching new stimulus. What are you paying attention to there?
Yeah, I continue to hold my ground on this and just say I think China's in severe trouble. I just think we're not getting the whole story. It's been propped up by this Fugazi real estate bubble over there, tons of stimulus. They're just talking like, oh, this is the first time we pumped stimulus in the Chinese economy. They've been pumping tons of stimulus in the form of modern monetary theory for 2 decades now. So, this idea that this is new is just ridiculous. They got their initial pop when we gave them favored nation status in the late 90s and the early 2000s. You saw China rip. And I think just, now, especially going into Trump 2.0, you got to remember Trump 2.0 is not good for China if you're going to go buy Chinese companies. It was horrible for Chinese stocks the first time around because he finally held China to the fire and said, guys, you're stealing all of our patents. You're stealing all of our IP. This is ridiculous. Like you can't do this anymore. And look at Chinese equities now. They peaked in 2021 at MCHI peaked at 96, and it got down to it went down 60%. It's still off the all-time high by 50%. I just think you're absolutely taking a huge risk if you're going out and buying this thing right now. So I'm still bearish on China, and will continue to be, right or wrong.
Okay. Why don't we talk duration real quick? Fed meeting next week. We'll see what they decide to do by the end of the year. I saw, 99% probability we're going to have another cut, most likely 25 basis points. Obviously, if you look at what the 10-year Treasury's done since they started the cutting cycle in September with that 50 bip cut, the 10 years up 57 basis points. They just control that front end of the curve. The market obviously thinks differently in the long end. Are you still cautious when it comes to adding duration to portfolios?
Yeah, I think so. I think you have to be careful. I think we could see two things happen, which is very similar to what we saw in the 80s under Ronald Reagan, where you saw persistent inflation, which certainly the last two, the CPI report that came out, the PPI report that came out, were not favorable for inflation.
They were very hot.
Very hot. So I don't think inflation has completely baked its way through the system, number one. And because of that, number two, I don't think people really understand how the yield curve works. If you avoid recession, I've been pounding the table on this all year. If you avoid recession, which it certainly looks like we did in 2024, it looks like we don't have, well, here's the crystal ball. Looking into the crystal ball, I think we avoided in 2025. Okay, so if you continue to have positive economic environment in 2025, I think yield curve continues to uninvert. So yeah, the Fed maybe cuts on the short end, and we get down to a more reasonable 3.5% or 4% 30-day Treasury or 1-year Treasury. But on the back end, you still could see a 5% 10-year. What's to say we don't have a 5% 10-year? And so again, the risk return profile to go out on the duration spectrum, I think it just doesn't make any sense right now.
Okay. Let's talk breadth and the Mag 7 versus the 493. It's really easy to track the Mags now with that Mags ETF. So up 73% year to date, and those top 7 companies make up 30% of the S&P roughly. So they've basically contributed to 80% of the return this year. We have seen breadth widen out a little bit. I know people right now are talking that more and more stocks are starting to underperform the S&P is a bearish reason to be looking at things. But, what do you think? Are we still moving in the right direction with those companies?
Yeah, the one that concerns me the most, and not a sell at all, but just concerns me would be Apple, right? Apple's been a story of stagnating revenue growth, stagnating earnings growth. But what have they done? They bought their shares back, tons of buyback, tons of dividend increases. And that has bolstered the stock in a huge way, right? We've reduced the numbers of shares outstanding. EPS has gone through the roof. There hasn't been a ton of growth. Here's my bull case on Apple and why I think it'll do fine is they are going to continue to pivot more into services revenue. They've been a little bit behind the 8 ball in product development, a little bit behind things, but everyone I think is understanding that Apple will be a major player with AI. Dan Ives certainly has said that at Wedbush, so we've been following him pretty heavily. Is Apple richly valued? Yes. Is Microsoft richly valued? I think Microsoft is probably fairly valued. I think Microsoft is just so ingrained into everything we do. We literally wouldn't be able to run this show today without Microsoft, right? We wouldn't be able to run it without Apple either. We wouldn't be able to run it without AWS, Amazon Web Services. So the Mag 7 story is so baked into the economy. It's so important to our day-to-day lives. So the only bearish scenario there with the Mag 7 is you see some breakups. Okay, Trump does not like the Mag 7. Certainly JD hates the Mag 7. He said it on every interview. He said, we're going to break these companies up. I don't like big tech. So you see the pivot with big tech now, right? What's Zuck doing? Zuck's coming in with what, $1 million donation to the Trump campaign?
Well, and Bezos just did the same thing. They're all kissing the ring.
Yeah, they're doing what they got to do. Why do you think Elon pivoted? All these major CEOs are pivoting. Maybe they like Trump secretly, but maybe not. I think a lot of it is, hey, we gotta go along to get along. Now, if they get broken up, which is, I think it's a slight possibility. I don't think it's a major probability. If they get broken up, you're still going to own all these different pieces just as different companies, right? Like YouTube spun off as its own thing is so valuable. It's insane, right? All these different pieces, Google Cloud, if it gets spun off, is still super valuable. So I wouldn't be overly bearish on it. If the market thought this was going to happen in a horrible way, we'd already be pricing it in. Look at Google this year. Google's been under the most fire. I think we could agree. And year to date, Google's up 38%. So the market's telling you this is not as big of a concern as you might think it is.
Okay, why don't we finishing up? Give us a little sneak peek into what to listen to next week when you do the live show.
Yeah, absolutely. And by the way, thank you so much to all of our guests who have been on this year. Thank you to Bill Baruch and Martin Norton and Tim Urbanowitz and Dr. Siegel. And we just had Yardeni, like you mentioned. It's just
Schwartz, Matt Cole, all those guys, McGarrell and
Bob Stein.
I think we hit them all.
Yeah. And hopefully we didn't miss anyone. If we missed you, thank you. We love you. And it's been just such an incredible season for Bullish. I think our first full season, really.
Yeah.
As we look to next year, just want to keep people on their plans, keep you bullish. We called the show Bullish just to give you the optimistic, positive reasons to stay invested. And I think next year you're going to have a lot of doom and gloom. You're going to have a lot of negative stories, just like you had the first, every initial part of a election cycle you do, right? And historically, though, that first year of the election cycle is very good. So I think we're going to have a good year next year. Maybe not 28% returns, but I still think it's going to be good. And just ignore the doom and gloom nonsense. We are watching out into the market. We're looking at everything. We read everything. We listen to everything. And we know why people are bearish. I think we understand why people have gone down this doom and gloom road where they're now they have the tombstone. And I can understand it. I can understand why people get bearish. But if you look at human history, if you look at the history of the United States, it's favored optimism. It's favored people just staying on their plans and being bullish. And I think that's going to continue to be true next year. So we hope you come back and listen to the show. We've got some incredible guests lined up. Hopefully some exciting ones we can announce pretty soon. We're doing Investor Day in October next year. So if you haven't made it out to Investor Day yet, you have to do that. And then we're going down to Houston and doing a mini Investor Day, basically.
Yeah, doing an overnight at the Four Seasons, where we're going to be doing a half day covering our philosophy on things and how we work. So that's going to be late April. Mark your calendars. That's going to be really exciting. We're just finishing up all the details, getting that locked in. And then, just trying to continue to bring phenomenal content. Obviously, if you listen to this, you probably listen to the Nick Stenger show, but if you don't, check out Nick's weekly podcast he puts out. We really appreciate you all listening. Be sure you like, subscribe again, and share that to get the clarity, the confidence, our bullish reasons to stay optimistic in the markets. And thanks so much. We wish you a Merry Christmas and Happy New Year.
Merry Christmas.